following is a paid program. Talk 103.7 WTIB and Cable Channel 7 welcome you into Financially Speaking with Jim Taunton. Find us live on radio, TV, the IBX Media app, and on YouTube. Just search Financially Speaking NC or get the link at WTIBFM.com. The opinions expressed in this show are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities and investment advisory services are offered through Genois Wealth Management Incorporated, member FINRA SIPC. Now, here's your host for Financially Speaking, certified financial advisor, Jim Taunton.
Welcome to Financially Speaking. Jim Taunton here with Jameson to serve you. And we'd love to have a call from you. And I'm glad I could say that. Actually, they had some phone difficulties at the studio. And they got that fixed. So we actually can have a caller. So give us a call at 561-TALK, 561-8255, 561-8255. And we'll take your call after the first break. And if you call in, as usual, I'll send you to Atavola, and I'll even pay the tip. Great place to eat. So give us a call, 561-TALK, 561-8255. We'd much rather talk to you about something that you feel is important or pertinent to you. So we'll go to a quick 2-minute break and take your call when we come back.
Aiden Golf and Country Club invites you to become a member. Come tour our beautiful clubhouse, ballroom, and facilities. For a quality golf experience, sign up for our discounted special membership rates, low monthly dues with no quarterly food minimum or assessments. Folks love to play golf at Aiden Golf and Country Club. Cool off at the pool all summer. Enjoy excellent food and beverages from the snack bar. Even store your own cart, unless you like to walk. Call 746-3389 for special limited membership rates at the Aiden Golf and Country Club.
My practice has been built on accessibility, responsiveness, and a willingness to be proactive for my clients. I'm not afraid to make recommendations relating to your investments and planning. I do hope all of your financial decisions are good ones, but let's not rely on hope. Let's roll up our sleeves and get to work.
Jim has attained 3 professional designations: Certified Financial Planner, Chartered Life Underwriter, and Chartered Financial Consultant, which entails 20 courses of study with examinations and a comprehensive national board exam, administered by the Certified Financial Planning Board. Jim has been practicing in financial services since 1979, which includes investing, planning, and insurance to help you meet your financial goals. Among the many awards Jim has received in his career is his selection to the Guide of the Top Financial Planners by the Consumer Research Council of America. So if you want to work with someone who is working for you, call Jim at 756-4700 or email him at planning@financiallyspeaking.com. That's 756-4700 and planning@financiallyspeaking.com.
Welcome back to Financially Speaking. Jim Taunton here, and Jameson is with us, I believe, but there he is. They brought him back.
Check.
He can hear now. We could hear him for sure, but now he can hear us. Last week I talked about the fog of war, and that's what we're in right now. And the fog basically, what it does is you can't see ahead. You don't know what's coming when you're in a fog. And that's what war is doing to the economy, not only U.S., but globally. And there are people using the R word now, recession, but that's standard operating procedure anytime there's some upheaval. And it feels like such a rerun, because we have managed clients' money through 6 bear markets and 6 recessions. So we have seen this movie before. And I know, be careful about the rattling around. It's coming over really loud. So we can more or less tell when a recession might be coming. And I don't think it is, but we're going to talk about it today. And one of the things that's going to cause inflation to rear its ugly head. Now, if we had recession with inflation, do you know what that's called, Jameson? Inflation and recession.
Can you hear me?
Yeah.
You cut out a little bit. Sorry, I didn't hear that last part.
Do you know what inflation and recession is called?
I don't.
I bet the listeners don't either, but it's called stagflation. It means we have a contracting economy, but inflation, and that's probably what we would have if we had a recession. But again, I don't believe we will. But one of the things that's going to cause inflation to rear its ugly head again, it's going to probably get up at least to the high twos again, if not three, is the fact that a lot of the liquid natural gas production has been wiped out. And much of the fertilizer that farmers use comes from liquid natural gas. And so prices of food are going to go up. And of course, we know energy has already gone up considerably. So it's going to affect us. There's going to be a little bubble of inflation working its way through the economy. But hopefully it'll be quick, get through, and we can end this war in the next week or two and kind of get back to some normality. In any case, that's what we're hoping. But so no fertilizers, so the farmers couldn't, grow their crops like they needed to, and so we're going to have a shortage of some things. But this too shall pass. We just need to get the war over and get it done with. Get the Strait of Hormuz opened up, and things will normalize very quickly. That is why I don't believe we're going to have inflation or recession. I'm sorry. If you remember, talking to the listeners, because I'm sure Jameson didn't watch the program back then, in 2022, many economists and people in the know were saying definitely we're going to end up in recession this year. Well, I came on this program and put myself out on a limb, and again, I'm just a little old podunk advisor in Eastern North Carolina that doesn't know anything. I just read a lot and listen to a lot of people. And the people I listened to and respected at that time were saying no. And I believe that after the research I had done. I didn't believe we were going to have a recession. I told the listening audience we wouldn't. And we did not end up in recession, and I don't believe we will now. Barring an unforeseen event, we already had one unforeseen event, which was the Iranian war. But I've got some information, Jameson, I put together about recessions. And then I've also did a little smidge of research on my phone, actually, and about returns of markets in and around recessions. So the first thing I want to clear up, and I said this in 2022, recessions are nothing to be feared. They're just a regular part of the economic cycle. You go through them periodically. Vast majority of recessions are quick, and the market is not affected tremendously in any case. And first of all, let's talk about what a recession is. A recession, the textbook definition, is a negative GDP or contracting economy for 2 consecutive quarters. Now, to meet that definition, you could contract by 1% over 6 months, or 10% over 6 months, or 0.5% over 6 months. So the degree of contraction is very important. And what I believe, and I said this in 2022 at that point, that if we did have recession, that it would be very shallow and very short-lived. And did you happen to look at anything about recession, Jameson, to share with the folks before I continue?
Yeah, just a little bit. Obviously, like you said, recession, people hear it, the big R word, it can be scary, especially when, looking past the economy portion of it. But when we talk about investing, it's scary investing in downturns, can be. But that's where having an advisor is most important, I think. We have a little sign here at the office that says, trade your plan, not your emotions. And recessions can certainly trigger those emotions. And, us as advisors, we have to, look past that, put the blinders on, and kind of stick with the plan that we've developed through experience. And, it's kind of the most value that we can provide during that time. But there's a way to invest during a recession, which can kind of help offset, some of those downturns, and something that we talked about discussing here before, and that's dollar cost averaging, which we implement, fairly often in certain situations. And really the two ways that we can dollar cost average. Not every investor that comes in brings us a lump sum amount, whether it be from a rollover, some they've had in savings building up for a while. Some investors come in and they're looking just to whether it be starting young or whatnot, just put a certain amount each month through recurring investments. And that, yep.
Yeah, I was just going to say, I talked about this on the program years ago, and I haven't talked about it very often. But yeah, like you were saying, the traditional method of dollar cost averaging is just plowing money in on a monthly basis every month, same amount on a draft, and watch it grow. But if you have a client with a lump sum, and it's a situation where you think dollar cost averaging would be more beneficial, and when you're at tumultuous times, you don't know where the market's heading in the next few months, and you have the opportunity when you get new money of making a good decision with it. There's a way to actually lump sum or dollar cost average a lump sum into the market as well. And we've done that many times. You take the lump sum and put it into some sort of fixed income account so that money that's in there is earning a fixed return over a period of time. But each month you're taking maybe 1/6 of that money and putting it into an equity allocation. So after 2 months, you've got 1/3 of the money invested. After 3 months, you've got half the money invested. What that does for you, is a quasi dollar cost averaging, but also, let's suppose 3 months into this process, the market just is absolutely tanking. Well, you can stop the process of investing additional money until you feel it's a better time to restart it and take advantage of that. But we're not timers at all. We've talked about it on the program a lot. We definitely don't believe in timing the market. Nobody's ever done that successfully at any level. We're talking guys that manage billions of dollars cannot time the market consistently well. So we're not timers. But there are times that you might, if there's a fundamental issue, retract money from market. But for the most part, you want to get it invested and remain invested, over your long investment strategy. And typically, investment strategy might last a lifetime. So
that's typically where the diversification comes in as being an important piece of your investment strategy. And obviously, meeting with your advisor often to know truly about what you're invested in and maybe how different market environments can affect that type of investment. And it's different for everybody. I mean, younger client that is just getting started investing, that's putting, $100, $200, $500 a month, whatever it may be, a little downturn in the market, most of the time we'll just plow right on through, keep that timely investment coming in every month. If the market's down, they're able to buy more with that. Versus the client who may be in retirement that is earning an income off of their investment. We have to manage that, a little closer to the belt, just making sure that, because they're taking money out. So when the market goes down, account value goes down, investment performance goes down, the withdrawals that they're making, whether it be on a monthly basis or whatever, it affects it even more. So we definitely have to look out for those clients and account types even more.
In 2020, what was happening in 2020?
Is that the, 2020? COVID. In 2020, the market was up 18.4%. And what's interesting to look, if you have a chart of the S&P 500 and you look at 20, the market was down 40% plus from February to April. And of course, clients get jittery. They start calling, Jim, we need to get out. And I said, of course not. These temporary circumstantial downturns are usually very short-lived. And lo and behold, we were down, from January, not for a lifetime of an account, but just for the year of 2020, from January 1st until, I believe it was about the end of April, the market was down 40+%. But look what happened. By December 31st, from January 1st, the market was up 18.11%. So if you sold out of the market because you were afraid, you shot yourself in the foot. And look at 2022. The year of 2022, we were down 18.11%. 2023, we're up 26.29%. So we made all that 18% back plus over 8% the following year. So if you sold out in 2022 because of fear, and most people don't know when to get back in, no one really knows when to get back in if you sell out of the market. That's why you stay invested most of the time. Only twice again in my 46-year career have I ever sold out completely cash temporarily. And they both turned out to be pretty good decisions, but when I did them, you don't know. You don't know for sure. And since that downturn in 22, in 23, we're up 26.29, 24 up 25%, and 25, we're up 17.88. Year to date this year, we're down. The market is down anyway. So is it time to bail because we've got some geopolitical upheaval and the market's down and people are spouting out the R word? No, you definitely not. You stick to your plan. And the information that I retrieved about recessions was listing a number of factors that are looked at to try to predict recessions, which are very, very difficult to predict. Economists, for the most part, can't hit the broadside of a barn. It's just true. I'll tell you what, we're right at a little beyond mid-program. We need to go to a mid-program break. Let's do that, a couple of minutes. That'll give people a chance to call. If you want to call and ask us a question, dial the number 561-TALK, 561-8255. If you call in with a question, your name goes into the drawing for the dinner of two at Octavol. I'll even pay the tip. And we'll be back with you in 2 minutes.
Golf and Country Club invites you to become a member. Come tour our beautiful clubhouse, ballroom, and facilities. For a quality golf experience, sign up for our discounted special membership rates, low monthly dues with no quarterly food minimum or assessments. Folks love to play golf at Ayton Golf and Country Club. Cool off at the pool all summer. Enjoy excellent food and beverages from the snack bar. Even store your own cart, unless you like to walk. Call 746-3389 for special limited membership rates at the Ayton Golf and Country Club.
My practice has been built on accessibility, responsiveness, and a willingness to be proactive for my clients. I'm not afraid to make recommendations relating to your investments and planning. I do hope all of your financial decisions are good ones, but let's not rely on hope. Let's roll up our sleeves and get to work.
Jim has attained 3 professional designations: Certified Financial Planner, Chartered Life Underwriter, and Chartered Financial Consultant, which entails 20 courses of study with examinations and a comprehensive national board exam, administered by the Certified Financial Planning Board. Jim has been practicing in financial services since 1979, which includes investing, planning, and insurance to help you meet your financial goals. Among the many awards Jim has received in his career is his selection to the Guide of the Top Financial Planners by the Consumer Research Council of America. So if you want to work with someone who is working for you, call Jim at 756-4700 or email him at planning@financiallyspeaking.com. That's 756-4700 and planning@financiallyspeaking.com.
Welcome back to Financially Speaking. Jim Taunton here with Jameson. And let me give you some information. I'm going to go through the factors that they look at, they being the people that know what they're doing, to determine if we're going into recession. And then I'm going to talk about some previous years where we had recession and how these same factors look. Job sentiment is pretty negative, has been like for the last 6 months to a year anyway. Jobless claims in good shape. Retail sales mediocre, but not negative. Wage growth is good shape. Commodities are good. ISM new orders are good. Profit margins are mediocre. Truck shipments are good. Credit spreads good. Money supply good. Yield curve good. So there really are no significant indications that we're heading into inflation. Now let's go back and look at some other years where we had inflation. The last year we had inflation was 2020, but I don't really call that a real inflation. That was something that we voluntarily did. We shut down the economy voluntarily, which in hindsight, I think 99.9% of people that know what they're doing and talking about would say was a mistake. But we did shut down the economy, and so I'm not even going to look at those numbers. But look at 2007, 2009. That's what we call the Great Recession. Worst recession and definitely the worst markets since the Depression, and some would say that it was worse than the Depression as far as markets were concerned. Jobs were terrible in the Depression. But look at all the negative factors that let people know we were heading into a pretty serious depression. Housing permits were way down. Job sentiment was terrible. Jobless claims were not good. Retail sales were down. Wage growth was down. Commodities were falling off the chart. ISM new orders were negative. Profit margins negative. Truck shipments were mediocre. Credit spreads were negative. Money supply negative. Yield curve negative. We had a lot of factors there that were telling us that we were heading into inflation. There is nothing like that right now. Nothing like that. So I just don't see inflation rearing its ugly head. So we're going to have a little bit more inflation, but no recession. We can handle a little bit more inflation. We don't want recession, although recession is in and of itself not extremely negative unless you lose your job. Then for you, it's very negative. So in any case, and that's it about recession. There is a sector that has been in the news probably for the last 6 months, maybe even up to a year. It's called private credit, private credit. And private credit actually became a sector after 2007 when there were some laws put into place that required banks to be so much more careful about who they were lending money to, because what caused us to go into the Great Recession was housing. And what caused the housing market to blow up was subprime loans. And guess who was the impetus behind subprime loans? It was Bill Clinton and his administration. They virtually forced banks to loan money to people that shouldn't have been borrowing the money to start with. And over time, it built and built and built, and finally it just came to a head. And people couldn't make their payments, and the subprime market just completely blew up. And so what developed after that, because banks now cannot loan unless you have pristine credit, 800 or higher, but not quite. That's a little hyperbole, but it has to be very, very good. So people are having to go outside of banks to borrow their money. They borrow money from private lenders. That's what this private credit market is. And then these private credit companies will box these loans together in funds and sell shares of that fund to individuals that want to invest in loans. And because these people couldn't qualify for bank loans, they're having to go to private credit. Their interest rate is higher. So the income on these funds is substantial compared to some other types of income funds. And we've seen some glitches in this market. We've actually seen funds that have exercised their contractual right to limit withdrawals or redemptions from these funds. Anytime that happens, it sends a shockwave. Now, the people that I listen to and respect are saying that this market is under control. It has been cauterized, so to speak. The bleeding has stopped, and we're not going to have a huge financial issue. And it wouldn't be anything like the subprime issue anyway. It's not nearly as large as the subprime issue in any case. But I just don't see this being an issue with us. So if people were thinking that was one of the things that might cause us to go into recession, that's not going to happen, in my humble opinion. James, did you know anything about this market?
Really, the only discussion or info I've ever had with it was with the wholesaler from the company. Are we allowed to mention specifics?
Apollo?
No, Lord Abbett.
Lord Abbott, yeah.
Yeah, just some various discussions. I mean, it's a lot of times it's for higher net worth clients. It's their portfolio. I actually just pulled it up and was looking at it as we were speaking. But their private credit, it's it doesn't look bad. It does offer higher income, but obviously there's can be some volatility there. And you were mentioning about the subprime. A good movie to go watch. I think it's called The Big Short. Is that right?
Yes.
With Steve Carell, Ryan Gosling. It does a really good job of explaining everything that happened and why and what this means. So it's a good watch.
It is a good movie. Yeah, there's another fund. They used to be called Griffin Capital, but Griffin was bought by Apollo. And Apollo is one that's been in the news a lot. That's one that has limited redemptions. They're going to be fine. We're not going to have a recession. Inflation's going to go up a little bit. As soon as this war ends, the Strait of Hormuz opens, it's all going away. And
Yeah,
be
but
glad
take
you
this as a
didn't
sign
sell.
to go meet with your advisor, get caught up on your strategy,
Yeah.
and make sure you're on the same page. If you don't have
That's
one,
right.
let us interview for the job. We're more than happy to help. But, get caught up. Know what's going on in your portfolio.
And as always, this is Jim and Jameson Taunton helping you make all of your financial decisions good ones. Good night, everybody.
Good night.